Market versus limit orders. Let's talk about them. When you're on your investing platform, buying or selling stocks or ETFs, you have different options for order types. Every order is either a bid for the stock, a buy order, or an ask for the stock, which is a sell order. Let's make things a little simpler. Imagine you're at a restaurant. Let's say you go to the restaurant and want to buy the steak. If you place a market order with the waiter, you're buying the steak at whatever price that the restaurant is selling at. If it's listed at $50, then you buy it for $50. Placing a market order in the stock market works in the same way. You're buying the stock at whatever price that the market offers. Limit orders are slightly different. In this instance, you tell the waiter that you want the steak, but you're not going to pay more than $40 for it. The waiter goes to the kitchen, but won't bring you your steak unless it's priced at $40 or less. If the price is above $40, they'll wait until it drops before they bring it to you to eat. Execution of the buy order doesn't happen until the price falls to $40. A limit order means that you're never paying more than you want for a stock or ETF. Limit orders also remain active until they are cancelled. In our restaurant analogy, you can go home after ordering. The waiter can then alert you if the price of the steak falls below $40. But it's also worth noting that if the steak price doesn't fall to $40, the order won't be filled. You could be left hungry and either have to adjust your limit order to a higher price or not buy the steak. Applying the same concepts to stocks, your order might not get filled with a limit order if the price doesn't match. The same principles apply when setting sell orders. You can either sell at the market price or set a limit order, which is the lowest price that you're willing to sell at. And that's the difference between a market and a limit order in under 2 minutes.